So you've decided to invest in real estate. In this video, we're going to show you the steps involved that you'll need to do to buy your first investment property. The first thing you're going to want to do is get pre-approved. Once you know what you can afford, then obviously we know what location and what type of properties we can look for. All right, so the first thing you want to do when you're thinking about investing in real estate is talk to a mortgage broker and get pre-approved. It's the most important step because once you're pre-approved, then we know what location and what style of home you're going to purchase and at least what type of investment that we can go find. So when you're talking to the bank and getting pre-approved, a lot of things they're going to look for is obviously your credit score. It's going to look at your employment history, your current income. It's also going to look at your debts. So it's really important at this stage to have all of your debts and your income and your taxes essentially taken care of. Some big things that do get in the way sometimes are big car payments or student loans. So those are the type of things that you're going to want to look at and manage kind of before you start looking at investing in real estate. Okay, now that you're pre-approved, the next question is what type of property do I buy and where? So in the Niagara region, when you're starting out investing, for the most part, you're going to be looking at three types of properties. You're going to be looking at a single family home, a duplex, or a triplex. Now, single family homes have a lot of potential because you convert them into duplexes. And by doing that, you can generate a lot of equity and cash flow. So the one most important thing to remember when you are investing in real estate is you want to make your money going in. And you do that by buying a property under market value. If you determine that a property is worth, say, $200,000, your goal is to get that property for under that price. By doing that, you create equity and then you create wealth well before you even purchase the property. So if there are some market shifts, you've already made your money going in. So the other major factor to look at when you're buying these properties are the location, the lot size, and usually the square footage of the home. These are the things that you more or less cannot change, and they're large factors into determining the future value of the home. Everything else we can kind of fix on the inside, but the lot size, location, and the square footage are very important factors when you're looking at properties, and that's usually where we start. So then you want to look at the style of home, whether you want to buy a single family, a duplex, or a triplex. Each of these have their own advantages, and the most important thing with them is the cash flow. You want to look at what are your mortgage payments versus what is the rent you're bringing in and what is your cash flow per month. All right, so one thing to remember when you are buying investment properties with your mortgage is you do have to put a minimum of 20% down. If you were to move into the property, you can put as low as 5% down, but on an investment, you have to put a minimum of 20% down. So you have to make sure you have your down payment set before you buy an investment property. For this video, we're gonna focus on single family homes and what are your options when investing in those types of properties. So now you've determined you're gonna buy a single family home, what are the factors that you're gonna look at? You're definitely gonna look at like schools, amenities, because families are buying these homes. What are your options as an investor? As an investor, you're going to be looking at how can you buy this home and increase the value of this home, because that's what every investment's about. The one main goal of a lot of investors when they buy single family homes is they try to add an accessory unit, a second unit, and that's typically renovating the basement legally. And follow our next video, we'll show you how to renovate the basement legally, but you'll try to renovate the basement into a second unit, an in-law suite. By doing this, you're instantly going to increase the value of the home, and you're also going to increase your cash flow of the home. And that ties back into what we're talking about with equity and cash flow from your investment. So now let's get into the numbers of what this actually looks like. So now that you've purchased your property, your goal is to create equity and cash flow. Once you determine that you want to create equity in your property, the first question is how do we do that? So let's take, for example, you purchase a property for $300,000 with 20% down. That means your mortgage is $240,000. Okay, if we say our purchase price is $300,000, we put 20% down, our mortgage is $240K. When we talk about our cash flow, we look at our mortgage payment for $1,300 a month, and for round numbers, we'll use taxes $200, insurance $100. That gives us a total expenses of $1,600 a month. And let's say for this property, you could rent it out for $2,000 a month as a single family home. That means your cash flow is $400 per month on a single family home. So that's pretty good. However, if you want to increase this investment and create equity, one thing you can do is add a secondary unit or an in-law suite. So if we look at the same example and we say it costs $50,000 to add that accessory unit, and we get an appraisal, and let's say it comes in at $500,000. So 500K is our new value. And with a $50,000 investment, we have just increased the value of our property by 150,000. So our new equity is 150,000 plus our $50,000 investment to renovate. So we have $200,000 worth of equity now because we made that investment. Then when we look at the cash flow, because we have a second unit, our mortgage payments still stay the same. Our expenses for the most part will still stay the same. However, we can add a second unit, and let's say that unit rents out for $1,000 a month. We now have $2,000 plus $1,000. We now have $3,000 a month coming in rent, and we subtract that from our expenses of $1,600. We have created $1,400 worth of cash flow per month, and we've created $200,000 worth of equity. This is why people invest in real estate. This is how they create wealth, and this is one goal of when you purchase a single family home. So at this stage, you have your property. You can hold on to it, collect your cash flow, and manage your property. But what a lot of investors do is they start moving on to their second, third, and fourth properties, and they start building their portfolio. How do they do that? What they do is they refinance this property. Because you have such a high income and cash flow per month, you have the room to refinance the property, pull the equity out, and you have enough room to handle a higher mortgage payment, which the cash flow will pay for. By doing that, you do bring your cash flow down. However, that money you pay tax on anyways. So by bringing this payment down, you can pull your equity out, take that money. In this instance, it's $200,000. You can take that money and go buy another property and do the same thing. So now you have two properties instead of one. Your cash flow is less, but you have two properties appreciating, and you're still using that same initial investment you used from the first property. And this is how seasoned investors grow their portfolio and don't sell. They say to sell properties, you can get rich, but to get wealthy, you hold. So now that you have your first property, you've created equity, you've created cash flow. Here is the next step into creating generational wealth and building your real estate portfolio. Okay, so the final step into your first investment property is to bring in the BRRRR strategy. The BRRRR strategy is buy, renovate, rent, refinance, and repeat the process. The final one, repeating the process, is how seasoned real estate investors generate wealth. So the BRRRR strategy is all about retaining your money, retaining your equity, paying less taxes, and using your same investment to do it again and create wealth for yourself. So we bought our property, we renovated our property, we rented out our property. The next step is to refinance your property. By pulling that equity out, you can repeat the process. So if we use the example of the first property we talked about, we increased the value to $550,000. To buy your next property, if you're approved, of course, the bank will loan you up to 80% loan to value. So on that, that'd be $440,000. We purchased our other property for $300,000. So as long as you're approved, you have to go through another pre-approval process, but as long as you're approved, the bank should give you $140,000 towards your next property. So one thing to note on why we do this and how we do this. On our last example, that first house you bought, you were cash flowing $1,400 a month. Well, you have to pay tax on that money. So by refinancing the property, you are gonna have a higher mortgage on your initial property. You're gonna raise your mortgage payments. Your cash flow on that property is going to decrease. However, you're paying tax on that money anyways. So why not take out this $140,000, bring the payments up so your cash flow down, but you can use this $140,000 and buy another property, do the same thing on that property and start appreciating that property. That is what seasoned investors do, and that's the next step when you're starting out buying real estate. So what we've done here essentially is we've used our initial investment to purchase two properties. We purchased our first property and we've increased the value. We pulled that equity out and we used that to buy another property. We have decreased the cash flow per month on our first property, but that allows us now to own two pieces of real estate. And as the market increases and appreciates, that's going to be very good for building generational wealth and to obviously build your portfolio. And this is why investors continue to use the BRRRR strategy and to continue to refinance their properties, not sell them. So at this point in the video, I'm sure everyone's thinking when you refinance, especially with the hot topic right now is interest rates in real estate and interest rates going up. So one thing to consider when you are purchasing your first property or refinancing your first property for your second property is, do you want a fixed or variable mortgage rate? And one thing to consider is that if you purchase an investment property and you're gonna hold it long-term, you may want a fixed rate. The reason people do variable rates is because when you sell your property, you don't have to pay a large penalty. Whereas on a fixed rate, if you break that mortgage, you do pay a large penalty. But with the climate we're in, the fixed rate may make sense, but that is the one risk when you're doing all of this is the interest rates fluctuating. So that's a really important thing to look at when you're buying these and talk to your mortgage broker about. If you have any more questions on the market, any more questions on investing in real estate, we're very happy to help. And this is where the BRRRR strategy comes in. Buy,